We are, needless to say, doing a really deep dive now. Like we did a couple weeks ago, we did a deep dive on kind of the no tax on overtime, the no tax on tips, the Trump accounts, and the car loan deduction. This week, we're doing a deep dive on the senior deduction. We're doing changes in the itemized deductions. We're doing the charitable deduction changes, the gambling losses, and the child tax credit and business expenses. I'm exhausted just listing all of that off, but we're going to try and plow through it because people really are starting to ask some questions about what's the impact that this has on me.
Right. So everyone's asking what actually applies to me. And this could save you a lot of time and effort come tax time, because what if you don't actually even have to file a tax return? Or what if you've been itemizing in the past, but all these new limitations make it so you can't anymore? So you don't need to necessarily go through tracking all your medical expenses, charitable donations, that sort of stuff.
There's definitely some opportunities and things to be thinking about a little bit differently. So, Kristin, let's start with that senior deduction. Now, I'm confused because that was supposed to be the no tax on Social Security. Mm-hmm. What happened?
So we didn't get no tax on Social Security.
We didn't get it. Yeah.
So instead we got this extra deduction. So it is a $6,000 deduction per person over age 65. And essentially it just runs for the next 4 years, so 2025 to 2028. So if you're over 65 or 65 and older, and you don't need to be collecting Social Security, but if you are, it doesn't make a difference. So if you're over 65, that's the only limitation on it.
So that's a fascinating little twist. So it is not keyed based upon whether you are collecting Social Security or not. Mm-hmm. It is exclusively keyed on your age, which at 65, if you're planning on going to your full retirement age, which for most people is 67, mm-hmm. then you just picked up an extra deduction, and you're not, in fact, collecting Social Security.
Correct, yeah.
Interesting. Okay, so that's got broader wrinkles and implications than it might have just upon first initial impression.
Mm-hmm. Yep, and then on there is an income limitation. So this is something to keep in mind. So if you are a single filer, if your income is below $75,000, then you will get the full $6,000 deduction. But then there is a phase out between $75,000 to $175,000. So if you're in that range, then you're going to get a little bit less of that $6,000 deduction. And if you're over $175,000, then you won't get any deduction at all.
Now it's per person, right? So if it's a married couple and both of them are 65 and over, then it actually winds up being $12,000, right?
Right.
So if I heard that correctly, adjusted gross income less than 150 gets me the whole thing.
Correct, yes. Mm-hmm.
So if I've got $150,000 of income, tax bracket of 22, mm-hmm. so 22% of 12 grand, that's about a $2,600 savings.
Yeah, not bad.
That's real money. That's a real world implication. Mm-hmm. $2,600. That's the difference that this particular deduction winds up getting you. Now, there's some caveats, and we've talked a little bit about them, but I want to break down each one of them and kind of think about it as in terms of the questions that you have received so far, Kristin, at the office. First one, do I need to be on Social Security to take the deduction?
No.
Big no on that one. Mm-hmm. That's key. Can I get the deduction if I am under 65 and collecting Social Security?
No. So if you're on disability income, that does not count towards you.
Or early Social Security.
Right, none of it. No.
So it's 65. That's it. It's not a function of Social Security. That's a key point that we're trying to emphasize here. Now, what if I itemize my deductions?
Mm-hmm. Yes. Yep.
Oh, I still get it?
Yes. Yep. It just tacks on to just a regular deduction. Yeah. So it's not tied to your standard or itemized deductions.
So it's like a power booster. It's like a boost,
correct.
If you will.
Yeah.
Wow. Okay. All right. Well, that's all right. That's kind of cool. How do they determine that income? What's what's that 150 based on? What is that? Just straight income, or kind of are they kind of messing with the definition behind the scenes?
So it's your adjusted gross income plus a couple foreign exclusion items. But generally, if you look at line 11 of your tax return, that's the number they're looking at. So if you typically take deductions off of your income, those would not count. It's basically your gross income.
Okay. All right. So not doing a whole lot of funkiness in terms of what makes up that income limit.
Mm-hmm.
Very cool. All right. So then, if my only income is Social Security, so do I need to file a tax return? What should be my reaction?
Maybe.
Okay.
So depending on what your
That's
Social
any
Security
good
is.
CPA's answer, right?
It depends.
Maybe. Yes. Yes.
So if your only income is Social Security, then probably not, but it is something to double check. But because this is hitting millions of low and middle income seniors, it's going to probably reduce a lot of filing requirements on a lot of filers that are just collecting Social Security.
Well, and you also were sharing with me a story about, the impact of some folks that were always trying to kind of take money out of their IRA intentionally because they were in a low tax bracket and were able to do that and not have to pay taxes. There's a real planning opportunity for folks in that particular category.
Mm-hmm. Yeah. So we've got a client, it's a married couple. Every year around November, December, we do a tax projection for them because with their income, it's just Social Security, and we kind of project out how much they can take out from an IRA without triggering any tax implications. So in that case, why not pull money out of the IRA because it's not costing you anything?
And now the amount obviously will go up because of the extra deduction.
Mm-hmm. Usually it was about $20,000 per year, and now it's going to go up about $12,000 for them because of the extra standard deduction.
So that's a really unique. I mean, that's why we do taxes. Actually, do tax returns for our clients at Nelson Financial Planning. There's some real planning opportunities that if you're not kind of having that level of integration of your taxes and your investments, you might be missing the boat on some opportunity.
Right. Yeah, I mean, that saves them every year, and they're putting that money into an after-tax account, so lower tax rates, lower capital gains, all of that in the future.
Interesting stuff. Okay, so that's the senior deduction, right? That's the whole soup and nuts on that one, if you will. We'll shift gears. Let's talk about itemized deductions as well. And I guess this gets us into that SALT stuff, right?
Oh, yes. Yeah. So this was a heavily debated item when drafting of the bill. There was, certain sides of the party that were wanting higher levels or higher limits on this, some wanting lower. It was heavily debated.
Yeah, I mean, that's the whole discussion of you've got the high tax states that obviously wanted more of this deduction for their constituents versus the lower tax states that didn't really have as big of an impact. Now, again, the ability, if you're writing off your state and local taxes, so that's like real estate taxes, that's sales tax, we're talking about now you're itemizing in terms of being able to do that. So how does the cap work and kind of what, I'm sure that one's got some income parameters in there too. They all have income parameters in there. Yeah.
So the cap increased. It was $10,000. Now it's going up to $40,000. And this is for both single and married couples, which is a little bit unique. So if you're a married couple without any changes, your cap was at $10,000 for the past few years. Now it's going to go up to $40,000.
So that's a significant jump. I mean, obviously not as big as what many folks were hoping for, but certainly a significant jump in terms of how much that wound up going up. So in terms of strategy, to really maximize out that, what should somebody do?
You should try to bunch your deductions. So if there's a year where you might have property taxes that you can pay 2 years in 1 year,
sure,
that would be a good way to just get the maximum benefit. There are some income limitations on this, so something to keep in mind is that if your income exceeds $500,000 for married or $250,000 for single, there's going to be a threshold, and it's going to reduce the deduction you're allowed to have.
No, that's important. There's always those income thresholds and limitations, but certainly a powerful one. Well, we're going to take a break and, keep on rolling. We've covered the SALT limit. We've covered the other senior deduction, and so we're going to keep the conversation going here on Dollars and Cents after these messages.